Good morning, everybody. Thank you for joining me for today's webinar. My name is Amber Hines, and I'm the owner of Ashbur, where we specialize in Medicaid compliant annuities. Today, we're going to be talking about Medicaid crisis planning with IRAs or retirement accounts. If you're interested in a copy of the handouts from today's session, you can download those in the GoToWebinar dashboard under the handouts portion. And if you have any questions during today's presentation, feel free to type those into the questions tab of the GoToWebinar dashboard as well. Again, my name is Amber Hines, and I have spent the last 15 years working with elder law and estate planning attorneys to assist their clients with Medicaid compliant annuities. I am insurance licensed in all states, and I hold my Series 65 license with FINRA as well. So we are able to work with clients all across the country. Myself and my team, work completely remotely. I personally am in Georgia, and I have two other team members. One is in Wisconsin, and the other is in Florida. And I really created Ashbur to assist advisors and attorneys with pre-planning solutions as well as crisis Medicaid planning solutions. When it comes to pre-planning situations, clients that are looking to apply for a hybrid long-term care insurance policy, or like an annuity policy with a long-term care rider, a life insurance policy with a long-term care rider, those are solutions that we would be able to assist with, as well as crisis planning with the Medicaid compliant annuities and funeral policies, whole life insurance policies, things of that nature. So like I said, I've spent the last 15 years working with attorneys and advisors all across the country. We recently added another team member, Stuart Otto, who some of you may have worked with previously. He has almost 10 years of crisis planning experience as well. And so if you get any kind of email follow-up from Stuart, you can feel confident that he also is well-versed in the Medicaid SPIA arena as well. We do offer complimentary case analysis, so we will help you to determine the optimal amount that an annuity should be purchased for, the term of the annuity, and then which assets your clients may consider annuitizing. So especially if your clients have deferred annuities that have a lot of deferred gain, or a retirement account like we're going to be talking about today, we can help you to determine the best way to basically either protect that asset without having the client incur a whole bunch of tax consequences, or basically doing a direct transfer of that type of account into a non-countable asset for Medicaid qualification purposes. We do offer top-notch customer service. In most cases, we're able to get back to people within the same day with a proposal. So we like to say that it's the best experience that you'll have purchasing annuities. If you don't believe me, you can feel free to check out our Google page. We've had several law firms and advisors comment on our service and our knowledge level on the purchase of annuities when it comes to Medicaid crisis planning. So today we're talking primarily about retirement accounts, and Medicaid planning with retirement accounts can be confusing. A lot of your clients do own retirement accounts, so it's important to understand the different types of accounts that you'll see and the best way to plan with them. When we're talking about Medicaid asset limitations for a single applicant versus a married couple, usually a single person that does not have a spouse, the most common asset limitation that we are going to be faced with is around $2,000. This does vary by state, but the most common number across the country is going to be $2,000 of liquid assets that the Medicaid applicant is able to keep. When we have a married couple where one spouse is in a facility that is going to be applying for Medicaid and one spouse is still residing at home, we consider the spouse that is at home to be the community spouse, and they are usually able to keep around 1/2 of the couple's countable assets. Up to $148,620 is the most recent number. The 1/2 rule does depend on whether you reside in a state that has a minimum maximum number for the community spouse resource allowance. If you are in a state that only has a maximum, then you really don't have to worry about the 1/2 of the couple's countable resources. You would just be able to have the well spouse that is residing at home keep the full 148,620, and as long as they are under that number of countable assets, then they would qualify for, or the Medicaid applicant would qualify for Medicaid in that case. Same asset limitation when we're dealing with a married couple where we have a Medicaid applicant. They're generally going to be able to keep around $2,000 of assets. That number, again, can vary slightly, but the most common number is around $2,000. The type of assets that are included in the $2,000 or the 148,620 that I referenced is really going to be any account that can be liquidated to cash, such as checking accounts, savings accounts, CDs, brokerage accounts, life insurance cash value, deferred annuities, and then in most states, retirement accounts as well are going to be considered countable and would need to be dealt with in order for clients to qualify for Medicaid. This is not going to include assets like the home, a car, prepaid funeral expenses, personal assets that the personal belongings that the client owns. So those types of assets are not going to be included in the 2,000 or the 148,620 that the well spouse or the Medicaid applicant is able to keep. When we look at what Medicaid planning really means, the term Medicaid planning usually involves either spending down or protecting a person's assets so that they can financially qualify for Medicaid. Medicaid planning can be divided into two different types. We have pre-crisis planning, which usually takes place when clients are still healthy, and this may include clients considering purchasing long-term care insurance, whether it be a traditional long-term care insurance policy or a hybrid long-term care insurance policy. But the main aspect here is that the client still has to be insurable or healthy enough in order to qualify for those types of contracts. Usually from a legal perspective, when we're talking about pre-crisis planning, many times this will involve gifting assets or transferring assets into an irrevocable trust and then waiting out the current 5-year look-back period for transferring assets into a trust or gifting assets. The second type of Medicaid planning is going to be crisis planning, which is what we're talking about today. And this is really a situation where clients are already incurring the high cost of care, whether they're in assisted living or a nursing home, or maybe transitioning from a home health care situation into a facility, and they're trying to qualify for Medicaid as quickly as possible in order to assist with the cost associated to the long-term care that they're experiencing. Whether we're doing pre-crisis planning or crisis planning, one of the most difficult assets to plan for is going to be qualified or retirement IRA accounts. This really, the reason why it's so difficult to plan with these types of accounts is because of the income taxes that would be due upon liquidating or transferring ownership of a retirement account. So if we are talking about pre-crisis planning and you're trying to transfer assets into an irrevocable trust or make direct gifts to children, there would be income taxes that would be paid immediately upon making that transfer, because we can't just change ownership of a retirement account without the clients having to incur the tax consequences of changing ownership or gifting those accounts. We know that there's 10,000 baby boomers that are turning age 65 every single day. That's over 300 per hour, and that's 73 million over the next 10 years. And the big takeaway from this slide is the fact that this group controls the majority of the $29 trillion of qualified retirement or pre-tax accounts that are out there. So many of your clients are going to be in a situation where they come into your office and they have large retirement accounts, primarily because it's less common for clients to have large pensions, with companies going away from offering pensions and instead offering 401ks, or clients basically being able to save assets by, or planning for retirement by, using qualified accounts or IRA accounts. The different types of accounts that are included in this 29 trillion include traditional IRAs, 401ks, 403bs, 457s, thrift savings plans, basically any type of traditional IRA account or any employer-sponsored plan that are considered to be pre-tax accounts, where clients are not having to pay taxes on the money before they put the funds into one of these qualified plans. Qualified retirement accounts have doubled since the year 2000, and since 2007, qualified retirement plans have increased by $18 trillion. And again, this is really just to say that many of your clients have these types of accounts, and we need to know how to plan with these accounts in the most tax efficient way. The different types of retirement accounts or plans include a traditional individual retirement account, and this can be found under Internal Revenue Code Section 408. We also have Roth IRA plans, 401ks, and 403b plans. The general income tax treatment of non-Roth accounts, or like your traditional IRA accounts, include a pre-income tax contribution. So pre-tax dollars are being used to fund a traditional IRA account or a pre-tax retirement account. There is no income tax on the earnings as the money grows within the account, but upon liquidation or upon the client turning age 73 and receiving their required minimum distribution or annuitizing their account, the distribution or the income is going to be treated as ordinary income for tax consequences upon receipt of the pre-tax account. Whereas if we look at a Roth account is funded with post-income tax contributions. So contributions are made with after-tax dollars. There's not going to be any income tax on the earnings, and there is not any income tax due on the receipt of a Roth account. So if we do a liquidation of a Roth account, or if we annuitize a Roth account, there's not going to be the same income tax consequences as using a non-Roth account. The different types of assets that can be purchased within retirement accounts, we get a lot of questions related to this. If clients have bank accounts, credit unions, CDs, or money markets, those can be pre-tax dollars or IRA accounts that are used within the bank account or the credit union account. Also, we can have an investment account or a brokerage account that is consisting of IRA funds. Also, we can have IRA annuities, which is what this presentation is really going to be focused on. And then finally, there's also self-directed accounts for alternative investments, usually real estate or real estate investment trusts. Those also can be funded with IRA or pre-tax accounts as well. When we talk about Medicaid planning with retirement accounts, each state is different in terms of how retirement accounts are treated for Medicaid planning purposes. Each state is going to take one of the following positions. They're either going to completely exempt the retirement account or treat it as a non-countable asset that does not have to be spent down in order to secure Medicaid eligibility, or they're going to treat the IRA account as an exempt asset if the owner of the account is receiving their required minimum distribution for IRS purposes. And then finally, in the most common way that Medicaid is going to look at the retirement account is as an available resource or as an available asset, which is going to be countable for qualification of securing Medicaid eligibility. One thing to note also is that each state, they can differ as far as whether they treat the community spouses retirement account and the institutionalized spouses retirement account as accountable assets for one spouse versus the other. So for example, some states consider the community spouses retirement account to be non-countable, but they will count the institutionalized spouses retirement account as an available asset. Planning is going to be most complicated in states that consider the retirement account to be an available or accountable asset. Most of the country does treat retirement accounts this way. There's 40 states that treat the retirement account as an available asset that needs to be planned for in order to secure Medicaid eligibility. Medicaid crisis planning is going to be more difficult with these pre-tax accounts because of the income taxes that would be due upon liquidation or changing ownership of this account into a non-countable asset. The map that you're seeing on the screen here is showing which states consider the Medicaid applicant's retirement account to be countable versus an exempt asset. The states that are in orange on the screen, which there's only a handful of them, are going to consider the Medicaid applicant or the spouse that is applying for Medicaid to have their retirement account be completely exempt, or it will be exempt if the IRA owner is receiving their required minimum distribution for IRS purposes. In all of the states that you're seeing in white consider the Medicaid applicant's IRA to be a countable asset. So as you can see, most of the country does treat the Medicaid applicant's IRA as an available asset or an asset that needs to be planned for in order for that person to secure Medicaid eligibility. The map here is showing if you're dealing with a married couple and you have a community spouse or a well spouse, whether their retirement accounts are going to be considered countable or exempt. You'll see that there's more states that are in orange on this map that considers the community spouses IRA to be completely exempt or exempt if they are receiving systematic payments or their required minimum distribution. So two different states that you can look at, for example, Pennsylvania and Wisconsin, the Medicaid applicant's retirement account is going to be considered an available asset that needs to be dealt with, but Pennsylvania and Wisconsin both are states that consider the community spouses IRAs to be an exempt asset if the person is receiving their required minimum distribution. So just keep an eye on that if you are dealing with a married couple as to who owns the retirement account and whether it's going to be considered as an exempt asset or if you're going to have to plan with it because it's countable. The states on this map that are in white are states that consider the community spouses IRA account to be a countable asset. If you're in a state that exempts the IRAs completely or exempts them if the person is receiving their required minimum distribution, then Medicaid planning is pretty simple in those states because if the account is completely exempt, there's not really any planning that needs to be done in that case because it's already going to be considered a non-countable asset that you don't need to plan for. Whereas if you're in a state that considers the retirement account to be exempt if the person is receiving their required minimum distribution or receiving systematic payments, then it's pretty easy also to just have the client reach out to the current IRA custodian and have them turn on the RMD requirements or the systematic payments in order for Medicaid to consider that account to be a non-countable asset as well. If you're in a state that counts the IRA as an available asset, we basically need to convert the IRA account or the retirement account from an available asset into an unavailable or exempt asset in order to secure Medicaid eligibility. And we can do this by converting the retirement account into an IRA Medicaid compliant annuity contract. The screen here is showing you the Deficit Reduction Act regulations related to the purchase of an annuity contract. The section that you're seeing in gray applies to all annuities, whether they are purchased with pre-tax dollars or after-tax dollars. And this is the requirement that the state Medicaid agency must be listed as a remainder beneficiary on the annuity contract to the extent that they have provided Medicaid benefits on behalf of the Medicaid applicant. There are a couple of exceptions to this if there is a minor or disabled child, or if you have a community spouse that is being named as a primary beneficiary on the Medicaid applicant's annuity, then those parties can be listed as a primary beneficiary before the state Medicaid agency. The section of the slide that you're seeing in blue applies to annuities that are purchased with qualified or pre-tax dollars or money that is currently in a retirement account. You'll notice that there's an or between the section that is in blue and the section that's in orange. The orange requirements that you're seeing on the screen, that the annuity must be irrevocable, non-assignable, actuarially sound, and make equal payments, that applies to annuities that are being purchased with after-tax dollars. So many people are unaware of the fact that there are different requirements for an annuity that is purchased with retirement assets versus an annuity that is purchased with after-tax dollars. So kind of to summarize the previous slide, if a Medicaid compliant annuity is being purchased with money that's in a retirement account, we usually refer to that as an IRA Medicaid compliant annuity. The annuity must name the state Medicaid agency as the beneficiary, but the IRA Medicaid compliant annuity does not need to be actuarially sound. It does not need to make equal payments, and it can have a balloon payment. So basically, the IRA MCA can be structured longer than the person's Medicaid life expectancy. It doesn't need to be actuarially sound, and it can make a balloon payment if we choose to do that. This slide is just summarizing the differences between your non-IRA MCA, which is all of the requirements that most people are aware of as far as the annuity must be irrevocable, non-assignable, be actuarially sound, meaning that the investment amount that is used to purchase the annuity is returned to the person within their Medicaid life expectancy, and we cannot structure that longer than the person's life expectancy. Also, with the non-IRA MCA, the payments from the annuity must be equal payments without any deferral or balloon payment at the end, or a very large payment at the end of the contract. And then the state Medicaid agency must be listed as a beneficiary on the annuity contract as well. When we're looking at an IRA Medicaid compliant annuity, the main requirement is that the state Medicaid agency must be listed as a beneficiary, and it also likely needs to be annuitized or converted into an irrevocable income stream so that Medicaid does not consider the account to be an available asset or a resource that can be liquidated to cash. Also, I put the requirement of irrevocable and non-assignable so that the contract is not viewed by Medicaid as an annuity that a company like J.G. Wentworth or Peachtree could potentially purchase because it has some value on the secondary annuity market. A lot of times I'll just mention with an IRA Medicaid compliant annuity, there's some institutions, retirement institutions, that clients will have or that they will use, maybe if they were a teacher or a professor, where they offer limited options for a payout. they'll require that the annuity must be structured for, let's just say, a 10-year or a 20-year time frame in order to annuitize the account. That will be okay to use an annuity like that if it's within a qualified retirement account, as long as the state Medicaid agency is listed as a beneficiary on that contract. So if you have clients that have retirement accounts that can't necessarily be transferred to another institution in order to meet all of the criteria that we would normally use on an annuity, then that's usually okay, because the annuity doesn't have to be actuarially sound, even if the contract is going to exceed what the person's Medicaid life expectancy is. I just know I've run into situations where we don't have the ability to transfer retirement accounts to another custodian, and we're limited by the payout structure that the existing retirement custodian would have. If your state treats retirement accounts as an available or accountable asset, clients have two options in order to spend down the existing retirement account. First, they can surrender the account and pay all of the taxes up front. Second, and the better option in a lot of cases, is to transfer or roll over the account into a Medicaid compliant annuity. If we look at a scenario where a client has around $100,000 in an IRA that is going to be considered accountable asset in your state, the first option that they would have would be to surrender the IRA account. Upon surrendering the IRA account, the client would have to pay all of the income taxes due on the $100,000 because that money has not been taxed before. At the point that the funds have been surrendered and taxes have been paid upon liquidation, then all of the money that is remaining after that liquidation takes place is now going to be considered non-qualified or post-tax dollars. So we'll assume this client is going to have to pay 22% tax on the $100,000 IRA. After paying $22,000 in taxes on the IRA by liquidating the account, he would have approximately $78,000 then to use in order to purchase a non-qualified or a post-tax dollar Medicaid compliant annuity. By surrendering the retirement account, the client is going to immediately lose the $22,000 by paying the tax bill. And after the client liquidates the IRA, pays all the taxes, now all of the assets are going to be considered post-tax dollars or non-qualified funds. The second option would be, instead of liquidating the $100,000 IRA and paying all of the $22,000 of taxes up front, the client could consider using the $100,000 IRA to purchase an IRA Medicaid compliant annuity. By doing this and converting his IRA into a Medicaid compliant annuity, his IRA is no longer going to be considered accountable or an available asset. An example of converting the $100,000 IRA into an IRA Medicaid compliant annuity would be to transfer the $100,000 to a company that offers a Medicaid compliant annuity that's going to pay out for a time frame of 60 months or 5 years in this case. If we look at putting $100,000 into a 60-month annuity, the monthly payment on the contract is going to be around $1,750 per month. The full $1,750, as the payments are being made back to the client, are going to be considered taxable income to that client. They will receive a 1099 from the insurance company at the end of each year that's showing the $1,750 per month as a taxable distribution, or around $21,000 per year. That is considered an additional taxable income that the client has as the payments are being made from the annuity. The total payout of $105,000 is basically representing the initial $100,000 that was used to purchase the annuity, plus a small amount of interest that would be paid on the annuity contract. Mainly the main benefit in this case would be spreading out the tax consequences over 5 or 6 different tax years as the annuity is making payments. So we could definitely shorten this term to say like a 2-year time frame, a 3-year time frame. We're still going to be spreading out the tax consequences as the annuity is making payments. So it's not an immediate hit of the $22,000 by liquidating the account, but instead the client is going to receive a 1099 and is going to pay taxes as the annuity makes payments. The other thing to consider with the IRA Medicaid compliant annuity is that since we are using pre-tax dollars, we could consider using a balloon style annuity if we wanted to do that, where the annuity is going to only pay what the client's required minimum distribution is, and then at the end there would be a large balloon payment that could be rolled back into another IRA account if the client chooses to do that. So here I illustrated equal monthly payments on the annuity, but that's not a requirement if we're using pre-tax dollars to purchase the contract. When we look at funding an IRA Medicaid compliant annuity with retirement accounts, clients really have 2 different options for the funding of the contract. We can either use a trustee to trustee transfer or a 60-day rollover in order to purchase the IRA Medicaid compliant contract. The transfer of retirement accounts, if we're doing a trustee to trustee transfer, the insurance company that is issuing the IRA Medicaid compliant annuity is going to obtain the money directly from the current custodian that is holding the existing IRA account, whereas a 60-day rollover is going to involve the client requesting that the existing custodian of the IRA liquidate the account without having any taxes withheld, and then we reinvest that money within a 60-day time frame in order to qualify the transaction as a 60-day rollover. The differences between the two when we're talking about a direct trustee to trustee transfer, we can do unlimited transfers in a 12-month period. So if your clients have multiple IRA accounts, we would need to do a direct trustee to trustee transfer of the IRA accounts into an IRA Medicaid compliant annuity, because the 60-day rollover option is only a option if we have a client that has one IRA account, because the IRS limits us to doing one rollover per 12-month period. So if there's multiple IRA accounts that we're trying to convert into an IRA Medicaid compliant annuity, we're going to be required to do the trustee to trustee transfer if we don't want the client to be taxed on any of the distributions from the existing retirement accounts. An advantage of the direct trustee to trustee transfer is that the tax reporting is completed between the 2 different custodians. So the IRA Medicaid compliant annuity custodian and the custodian that was previously holding the money, they are going to work together to do the tax reporting so that the client isn't having to prove that the money was invested within a 60-day time frame. With the 60-day rollover, the client is going to receive a 1099 for the distribution from the previous company, and then it would be up to the client to prove that they reinvested that money within a 60-day time frame to prove that it was a qualified rollover within the time frame that is acceptable by the IRS. The downside of a direct trustee to trustee transfer is that it can take a couple of weeks or over a month in order to complete, and this will delay Medicaid eligibility until we actually get the transfer of the retirement accounts into the IRA Medicaid compliant annuity. So I usually do request, if we are doing direct trustee to trustee transfers, that the client contact the existing custodian, let them know what we're trying to achieve, and have them request that they move as quickly as possible because we are trying to secure Medicaid eligibility. It usually does help if the client reaches out to the existing custodian directly and stresses that we're trying to get this done as quickly as possible. The advantage of the 60-day rollover is that it usually is a quicker process than the trustee to trustee transfer, because the existing custodian is going to act quicker when the client is requesting a liquidation directly versus doing a trustee to trustee transfer with another third-party insurance company. The different types of accounts that can be transferred or rolled over into an IRA Medicaid compliant annuity, it's not just one IRA to another. If clients have existing 403B accounts, 401ks, or other employer-sponsored retirement plans, we can use any of these accounts to transfer or roll over into an IRA Medicaid compliant annuity. I like the chart that you're seeing on the screen. It came directly from the IRS's website, where it's showing any of the funds that, or any of the different types of accounts that are in the left-hand column, whether it be a traditional IRA, a SEP IRA, a 457B, or any qualified plan. We can directly roll that over into a traditional IRA account that you're seeing in the second column. And any of the annuities that we would be purchasing with the companies that we work with would be considered a traditional IRA Medicaid compliant annuity. So it's not just one IRA account to another. We can have an employer sponsored plan that can be used to fund the IRA Medicaid compliant annuity. If we are dealing with a single person or a Medicaid applicant that does not have a spouse, there's really going to be 3 different planning opportunities when the Medicaid applicant has a retirement account that is considered a countable resource. In a single applicant case, we don't have a community spouse that we can be transferring assets to without penalty. So we have the option of either implementing a gift and IRA annuity plan, doing an IRA MCA without a gift, or doing a combination of the two. If we are looking at doing a gift and IRA Medicaid compliant annuity plan, the goal would be to gift as much of the after-tax dollars that the client has, gift that either into a trust or directly to giftees, and then use the majority of the IRA account to purchase an IRA Medicaid compliant annuity in order to pay during the private pay period or the penalty period that's associated to making a gift. So that would be one option. Another option would be to use an IRA Medicaid compliant annuity without gifting any of the assets. The goal or the benefit of using just a standalone IRA Medicaid compliant annuity is that we immediately secure Medicaid eligibility for a single applicant by converting their accountable assets into an income stream. The downside of the standalone annuity without any gift is that the state Medicaid agency is going to have to be the primary beneficiary to the extent that they provide Medicaid benefits. So if the Medicaid applicant predeceases the term and the state has paid quite a bit of money in Medicaid benefits, then that is going to potentially eat up the amount that is remaining for the contingent or secondary beneficiaries when we're doing a standalone Medicaid compliant annuity. And then the third option would be doing a combination of the two, a gift and an IRA Medicaid compliant contract. When we're dealing with a married couple where we have a Medicaid applicant and a community spouse or a well spouse that is residing at home, and we're assuming that retirement accounts are going to be treated as an available asset for both spouses. We have different options for the institutionalized spouses or the Medicaid applicants countable retirement account versus options for the community spouses retirement accounts. If we have a Medicaid applicant that has a countable asset and we have to spend them down to $2,000 or less in assets, then the options for that retirement account is really, the first option would be to completely liquidate the IRA that belongs to the Medicaid applicant, pay all of the taxes up front, and then purchase after-tax or non-qualified Medicaid compliant annuity that would be owned by the community spouse. There wouldn't be any penalties for transferring the after-tax dollars from the Medicaid applicant over to the community spouse because we can transfer assets in between spouses. But the downside of this first option is that we're paying all the taxes up front, and depending on the Medicaid applicant's anticipated longevity, we would want to make sure that we're not paying a large tax bill and we're not going to receive a benefit from Medicaid that is going to justify the tax bill from liquidating the IRA. The second option that we would have in order to deal with the institutionalized spouses retirement account that's considered countable would be to use an IRA rollover or transfer to convert the countable retirement account into an IRA Medicaid compliant annuity that would be owned by the Medicaid applicant, and the Medicaid applicant would also be the payee of the annuity. The benefit of considering this option is that we are able to secure immediate Medicaid eligibility and convert a countable IRA account into an IRA Medicaid compliant annuity. And the community spouse can be named as the primary death beneficiary on this contract because the Medicaid applicant is the owner of the account, and the community spouse would be able to be listed as the primary beneficiary before the state. The third option would be to use name on the check rule. This does only apply to states that are going to honor the name on the check rule. If you have questions about whether your state does honor this rule, you can reach out to me either by phone or email. Basically, the name on the check rule consists of using the same strategy as we talked about with option number 2, where a rollover or a transfer of the IRA account occurs and we purchase an IRA Medicaid compliant annuity that is owned by the Medicaid applicant, but we name the community spouse as the payee of the income stream. And also we name the community spouse as the primary beneficiary of the annuity before the state Medicaid agency. The benefit of using name on the check rule versus option number 2 is that with the payee of the annuity being the community spouse, if you're in a state that recognizes name on the check rule, then the payments from the IRA Medicaid compliant annuity is going to be considered protected income for the community spouse versus going towards the cost of care or the share of costs for the Medicaid applicant. The final option for the institutionalized spouses countable retirement account would be to consider using in-marriage quadro. And this really applies to states where the community spouses retirement accounts are exempt, or if we want to increase the community spouse's income beyond the minimum monthly maintenance needs allowance. So in-marriage quadro would allow for us to change ownership of the Medicaid applicant's retirement account over to the community spouse's retirement account. And it's really attractive in states that exempt the community spouse's retirement account because you can basically completely protect the retirement account that was previously owned by the Medicaid applicant by shifting the ownership over to the community spouse. The options when we have a community spouse that has retirement accounts that are considered accountable assets, the first option, depending on the value of the community spouse's retirement account, would be to keep the account as the protected community spouse resource allowance that the community spouse is able to keep. So for example, if we figure out that the community spouse is able to keep the maximum amount of 148,620 and they have an IRA account that's worth 100,000 or 50,000, any amount that would be less than the 148,000 that they're able to keep, then they could just keep the retirement account as part of their protected amount that they don't really have to do any type of spend down for, because the value of the retirement account is less than the protected amount that they're able to keep. The second option for an accountable retirement account that's owned by the community spouse would be to liquidate the IRA, pay the taxes, and then purchase a non-qualified Medicaid compliant annuity. I don't really know why we would do option number 2 unless it's a very small retirement account and we're simply just trying to consolidate assets in order to secure Medicaid eligibility. But the third option is really going to be the most common, and that is to purchase an IRA Medicaid compliant annuity with the accountable retirement account, have the community spouse be the owner of the MCA, and follow the requirements of naming the state as a beneficiary and being able to spread out the tax consequences over several years, depending on how long we structure the annuity for. Another question that comes up frequently when we're dealing with retirement accounts and clients that are trying to spend down for Medicaid qualification purposes is whether clients can purchase one IRA MCA and one non-qualified MCA, and the answer to that is yes. We do that all the time when it comes to, let's just say a client has a total spend down amount of 300,000 that they need to convert into a Medicaid compliant annuity. If the IRA is worth 100,000, we would do one annuity that is purchased with pre-tax dollars for the $100,000 IRA account, and then a second non-qualified annuity for the 200,000 that needs to be spent down. We can do different terms on each annuity. So if we want to stretch out the tax consequences on the IRA Medicaid compliant annuity, then we could do that for, say, a 4-year time frame, and the non-qualified annuity we could do for a shorter period of time, because the tax consequences on the non-qualified annuity are going to be nominal. It's really just the interest that is taxable on the non-qualified annuity. In summary, we're really here to assist you in your office with different Medicaid crisis solutions and planning services. We do offer complimentary analysis as far as looking at a set of case facts that you have and determining whether an annuity would make sense. We are here to assist through the whole process of the Medicaid annuity purchase. We do offer the ability to run quotes, send you pre-filled application documents that are very easy for the client to sign and complete. We do also have services if your client purchases an annuity that names the state as a beneficiary and the owner of the annuity would predecease the term. We will help to work out the claim amount with the state Medicaid agency and then get the secondary or the contingent beneficiaries paid, either the remaining payments that are in the contract or a lump sum of money. So we're going to stand behind the annuities that are purchased through our office. We're not just going to sell the annuity and then not have anything to do with the getting the annuity settled if we do have a death claim that occurs on an annuity that was purchased through our office. Our fees, if we do charge any, are going to be outlined in any quote that we would provide on the front end, and they only apply to annuities that are purchased for a short duration. Our fees are lower than our competitors, and so that's something that a lot of attorneys and agents that we work with appreciate. We have not had to increase any of our fees since I started Ashburr back in 2019. So if you work with us, you can feel confident that we're not going to increase fees on a regular basis. I know I covered a whole lot of information in the last 50 minutes, so if anybody has any questions, feel free to type those into the questions bar of the GoToWebinar dashboard. Otherwise, my contact information is on your screen. You can either shoot me an email at amber@ashburr.com or give me a call using the phone number that is on the screen. Does look like I have one question here. What do you recommend for a 65-year-old incapacitated single person who already converted his Roth IRA to a non-MCA years ago? No, there's no gifting in power of attorney or trust. So with that, I would really need to see the Roth MCA or the non-MCA contract to determine if the account is really annuitized. There's a lot of times that clients think that they have annuitized their retirement accounts and they actually have not. So if the contract has not been annuitized or irrevocably converted from a lump sum of money into an irrevocable income stream, then we would have some options to plan with that account. So if you could send me a copy of the existing account or a recent statement, I would be able to comment on that further. I don't see any other questions at this time, but again, I want to thank everybody for joining me today and be on the lookout for our webinar topic for next month in October. I appreciate all of you being here and thank you. Take care.